Hello, Jim here. We had an interesting week in the markets last week. The Fed did make the cut, a 0.5%, and they've alluded to two more cuts later in the year and possibly a couple more next year. I'm not so sure they're going to do more than one or two more. There's also a lot of pundits that are pointing to a potential recession or a major market drop. I'm also not sure that's going to happen. I do think we're going to have some crazy times. I think we'll have weeks that are way up and then weeks that are way down. And with the election coming up, I think that also could be some headwinds in the short term. I personally will be sticking to my same way of trading. I like to pick really good companies and I like to get them at really good prices. So today I'm going to talk about three stocks that I really like that I've done trades on before and I plan to do trades going forward. So I'm also going to talk about kind of this trade setup that I like for each of these. So stay tuned. I think you're really going to enjoy what I have for you. Okay, let's jump right in. Now, Logitech is one of the companies I've traded before. They currently have holds for most of the ratings, but I still like them. The fact that they have no debt and really good profitability. Their earnings, they did beat recently. Their year over year is down a bit, or will be down later in the year, but it's not way off of what they've done this year. So if they continue to beat earnings the way they have, they should do quite well. They also pay dividends and they're growing them nicely. So the yield is a little bit low, but again, you shouldn't worry about the yield. It's more important how quickly they're growing the dividends and then, what kind of payout ratio. So they have a very small payout ratio. They're only spending 27% of their earnings and they're growing the dividends nicely, almost 11% on a yearly basis. This is the 5-year growth rate. And they've been growing them for 10 years. So I like all that. Company growth is relatively low. So they're a big company. They're not growing crazy, but they do have fairly good growth. If you look at their year over year growth, it looks okay. Their revenue growth isn't so good, but their EBITDA growth does look fairly good. I'm not sure if I pronounced that right, but you can see here. And then profitability, I really like. They have return on common equity is over 30, 31, which is what I like to see. And they have return on assets in the teens and the very high teens. So I also like that. So they're a very well-run company. And again, they have no debt. So when I see a company that's well-run and has no debt, I typically do like it. Now, the last trade I did on them, let's look and see what it looks like. Now, this is Patreon. This is what's available to my memberships. I'm not going to go into detail about my memberships, but you can find in the description more details about it. If you're curious or interested, take a look. It may be worth your while. So I recently closed on May 9th, I closed my Logitech position, but here's the original position. I share this with all my members. So I originally, back in May, picked up $243 in premium, and I had picked a 75.65, so still fairly close. If you look over here, we go back to summary, they're currently at 86, so I'd prefer to get in closer to this 75 like I did earlier. And then I did take a little bit more risk. Now I believe they go in increments of $5, so it is a little bit harder to get an exact delta when you do the trade. So sometimes you do have to take a little bit more risk. So I did quite well with that. And like I said, I was able to close them a little less than a month later, which is good. And I believe the return on this particular trade was very good because I closed them for literally $10. Now, if I was to set up a new position, here's the option chain. This is on Schwab with Greeks. A lot of people prefer Thinkorswim, and I do have Thinkorswim, but a lot of times like to go back to the old interface, mainly because I've been using it for 15 years and I'm just very used to it. So here you can see at 80, it's a 15 delta. So you could do an 80.70 and bring in a little bit of cash, or you could take a little bit more risk and do an 82.75 and make a bit. Now, if I went out to November which is 54 days. And I don't mind going out 60 days. I typically will close a lot of my positions or manage them at 21 days. And a good number of them I am, like this one, the previous one I did on this, I was able to close early, and similar situation here. So here at a 19 delta, 19.1980, I could do a 77.50, 70, and it looks like I would bring in pretty close to $75, $80. And we can actually see that here. I'll jump into what the trade would look like. So if I did it on 11/15 and I did a 77.50 and a 70, so I'd bring in between 70 and 125. Now, I originally told people just to do market, especially with Schwab. I've more recently done limits. So for this trade, I would look at, I would probably start here, 125, and then maybe take $5 off. So with this, I would probably go up to, I might start as high as 120. And this is for one contract. So I could potentially pick up 120. Now, if I would then review the order, and if it didn't get filled, then I would go down a little bit. I might go down to 115 and then run the order again and see if it could get filled. But this is what I did before. And a lot of times, usually the second or third iteration, it will get filled and it'll work out well. So I like Logitech. I do think they're a good company long term. And again, they're not way overpriced. So just an overall good company to potentially go with. So let's jump into the next one. Okay, the second stock I wanted to talk about is DocuSign. Now, I've been interested in them primarily because being a software developer, one of my clients is going to be in direct competition with DocuSign. So it gives me an opportunity to kind of keep an eye on them and get a feel for their products, what they offer. And I do like them. I do find that they're also a well-run company, and they're also not overpriced. You can see here, they're kind of pretty close to the 52-week range, or the middle of the 52-week range, not necessarily at the top and not at the bottom, a little bit closer to the top. But they've been higher several times, and they've been lower. I do prefer them a little bit closer to $50. Their current PE is only 16.61, so they're not real pricey. I don't think that they're overvalued currently. I think they're fairly valued. I don't think they're cheap, but I also don't think they're expensive. Earnings, they've done well with earnings. They've beaten earnings recently, and they have pretty good year-over-year earnings. Even though this last quarter is a little bit down, it's still considerably higher than the third quarter of 2025. So earnings-wise, they've done really well. Their next earning date isn't until 12/5, so you can actually, look at setting up a position as late as November 15th. Dividends, they don't currently pay dividends. Growth, not the greatest growth, but not bad also. They definitely could do a little bit better growth-wise, but profitability, their profitability, just like Logitech, is really good. Their return on common equity is really high at 70%. You don't see many companies with return on equity this high. The return on total capital looks good. And then their return on assets is quite high, 26. I like to see in the teens, so the fact that their return on assets is so high is really good. They've also recently paid off all their debt, so they have no debt. So overall, they're a good company, well run, and they're not growing like crazy, but they're not overpriced, and they tend to do fairly well. Now, if we look at my recent trades, I did a 52.50, 42.50 that I closed recently for $14. But I had rolled it once. I rolled it back on June 10th and picked up some pretty good premium, $325 in premium. Kept the same strikes and rolled it out. I had originally done the trade back on April 15th, and at that time I brought in $311. And each of these were very, very profitable. So what can you do now? So here's the 5250. It's a 17 delta. So you could look at November and do another 5250. Probably you could, well, you see this value here, the 67 is a little bit pricey for the put, but you could do a 5250 45, which would be a $7.50 spread. So a smaller spread, you'd be using less capital. And you hopefully would be bringing in a fair amount. We can come over here and actually look at the setup for the trade. So I would also do a vertical put credit spread on DocuSign, and I would do a buy to open at 45. So I would pay 33 cents to open the downward protection, and then I would sell to open a 5250, which is very similar to the trade I did before, and I'd bring in anywhere from $34 to $80. So again, I would start probably pretty close to 80. I might come up here and do, I don't know, maybe 77, 78. Again, remember this is a $7.50 spread, and they were up that day. So typically if the market's down, you'd probably do a little bit better. You'd probably do closer to 85, 90. And you may end up doing more contracts. If you do 2 or 3 contracts, you could bring in a bit more. And like I said, I don't really think they're majorly overpriced. So I'm looking at doing another one. I would love to own them around 5250. So this is another trade, and the fact that they don't have earnings till early December, it's a good time to potentially do like I'm showing here in November. One thing I forgot to mention a minute ago is I do like how Schwab has added this, show full quote, and now they do include the delta. So you can see this is just shy of an 18 delta. Now, if I did this, I tried 1018, which would be my prerogative initially. I'm not seeing as much income here. If I went up to 55, let's see what 55 looks like. And mainly because it's expensive. Looks like a lot of people purchase puts, but I could pick up 26 or potentially as much as 69. But again, if it's a down day or we get a market drop, but 55 is a little bit expensive. I still prefer it 52.50. So that's DocuSign. If you've never traded in them, I suggest take a look. Next, let's jump into one of the other ones that I currently do own. They were assigned to me 2 years ago, and I've done quite well, and that's eBay. So let's jump into eBay. They have gotten a little bit more expensive recently until you look at the PE, and they have literally a 13 PE, and they are producing a lot of income. So with a second thought, they're not really that overpriced. I'd prefer to own them a little bit lower. But again, with a 13 PE, they're fairly, they're not overpriced. They're, could they be a little bit less expensive? Yes, but they're, depending on how you look at it, they could potentially go a lot higher if you compare them to an Amazon or some other companies that have much higher PEs. And then if you look at earnings, they also do quite well with earnings. They have pretty good year-over-year earnings. It looks like close to a 10 or 12% year-over-year increase, and they've beaten earnings the last 4 quarters. So they've done well. They did miss GAAP in earnings, but not by a whole lot. Dividends, now they're paying dividends, which is, I think, really good. They just started paying dividends a couple of years ago. They're currently paying 1.72%. Their payout ratio is pretty small at about 23%, and they're growing very quickly. The dividends, they're growing 20%, over 20% on a yearly basis. So you can do quite well long-term dividends wise. And then growth, kind of like the others, they don't necessarily, I don't know if you would characterize them as a growth company, but they're doing okay, and they're cutting costs and earnings per share. They're doing better, but They're not growing leaps and bounds compared to some other companies. Now, profitability is another area, just like the other two I shared with you. They have very good profitability. Again, return on common equity, like DocuSign, is way up there, 50%. And return on assets is in the teens, 13%. That's something I like to see. I mean, their asset turnover and a few parts of their profitability maybe not quite as good, but everything else, you look at the number of how much income they make per employee and how much cash they're generating from operations is pretty incredible. And they also have very little debt. All of the three of these companies, they may actually have no debt. I think they're either have just recently paid it off or paying it down pretty substantially. Now, I've traded them. I believe they were assigned to me 2 years ago. Might have been during 22. But I have been doing pretty well with rolling covered calls on them. So last time I rolled back in April, I brought in $246. I did run into the scenario that my call did end up deep in the money. You can see here it's 52.50. It hasn't been called away from me, but it's fairly profitable. I believe it's like a 20% profit after it was assigned to me. And then here you can see I closed an eBay position not long ago too. And then I believe February 21 is when they were assigned to me at $47.50, and I had brought in $205. Again, this is my Patreon. This is what I share with my members. So just like I did, they can go back and they can look at all these trades and what my thoughts were related to them. And then if you look at making a trade currently, November 15th, the one thing I didn't look at is when earnings are. So 10:30. So you do have to be careful. You want to be sure you really want to own them since you do have earnings, especially if you go out to 11:15, which here I'm looking at 11:15. I wouldn't mind picking up some more around 55 or 57.50. You can see one's a 12 delta, the other one's a 20 delta, mainly because they're jumping, their strikes are increasing at $2.50. So that's why there's such a big jump from the delta from 1270 to 2030. Now, if I go back to October 18th, yeah, weird data. I'm doing this on a Sunday, so the data is a little bit messed up for October for some reason. And then if I come and I show you what the trade would look like, again, I have eBay, it's a vertical put. Currently at $62, almost $63. I'm buying to open a 52.50. This is November 15th. Again, I'm 2 weeks after earnings. I believe earnings was 10:30 is what I saw over here. Yeah, 10:30. So I'm somewhat after earnings. And then I'm selling to open a 57.50 put, and I'm bringing in almost 90 cents. Now, this is another case of where the puts are pretty expensive for eBay, but I would still probably look at this starting at this 68 cents. So remember this is a thinner spread. This is 57.50, 52.50. You might ask, well, why am I doing that? Well, I started with the 47.50, and the pricing for the puts is really, really expensive. So then I went to 50, still way up there, 148. Then I went to 52.50. And it dropped down to 65 cents. So I would again go to pretty close to 66. So I would go probably up to, 65. And then I would review the order, make sure everything looks good, and then I would process it. Now, since this is a thinner spread, I may do more like 4 contracts and bring in 260 or possibly 3 contracts. Let's take them both down. And this is what a lot of the YouTubers talk about. They take huge risks. They'll go up to, 10 contracts and make a big pop of money. But in my mind, it's too risky. I prefer typically to do 2, but sometimes I'll do 3. I've noticed with some companies, and eBay may be one of them, I may start going to 3. And does jump up, and it's primarily because there's probably only a little bit of volume at that 65 cents for the ask. So that could be part of the reason why I'm picking up a little bit more premium if I go to 3. But I have gone to 3 on some trades recently. For the longest time, I would do 1 contract, then 2, and now I'm in some cases doing 3, where I feel like it's a great company at a great price. And I do believe eBay at 57.50 is a pretty good, maybe not as good as DocuSign and Logitech, but still a very good company, especially with the dividend. So that's what I wanted to show you guys. Just, I know some of you prefer Thinkorswim. I've done these kind of videos with Fidelity also, but a lot of times I do like to go back to Schwab. And me having traded on this platform for 15 years, I'm old fashioned. I like to work with, the old interface in a lot of ways. So let me know what you think. What do you think of these companies, these 3 companies? Are there any other companies you think might be better plays at this time? Again, I'm looking for great companies at really good prices. I'm trying to avoid paying too much for certain companies. So hope you enjoyed this. And as always, thanks for joining me.